Everyone, welcome back. Next up, we've got Irusha Peiris, who is a portfolio manager over at O'Neill Global Advisors. Really excited to hear his presentation about 20 lessons from 20 years of trading/investing. So Irusha, thank you, first of all, for coming on. I know I've gotten the pleasure of seeing some presentations from yourself and Mark Minervini as well. Those are great, and really looking forward to learning from you here today.
Well, thanks, Richard. Thanks also to Ross and Ray and everyone at TraderLine for the invitation to be here. It's been a great event. I mean, the lineup is pretty impressive. So I'm honored to be here. But yeah, so Richard mentioned I am a portfolio manager at O'Neill Global Advisors. I'm also helping the analyst team out at William O'Neill and Company, and I've been doing this for over 20 years now, which is it's gone by pretty fast. But before I was hosting the IBD podcast. I did that for a couple of years, and I was the director of MarketSmith. So a lot of all the charts that I'll show today are MarketSmith charts. Now, for those of you who are out there watching or who are trying to put this together, I get it. I started out as a customer years ago, back back in the late 90s during the .com era, and when the markets, 99, I thought I was a genius when these markets were going up. But in 2000, when everything came down, I rode the markets up. I just rode it right back down. I had no idea what I was doing. And so that really was what inspired me to start learning about technical analysis and getting a plan in place. And I came across IBD, Investors Business Daily. And so I really started to get into it around 2000. Daily Graphs Online was the predecessor of MarketSmith. So I was a subscriber of essentially the MarketSmith platform before I became the director of it. And I went to all of the IBD seminars available at that time as a customer. So I paid a ton of money to learn this stuff, and it's the knowledge that's being shared over this past weekend at this TraderLine event is incredible. It's amazing that it's free. This was content that I was paying thousands of dollars for. So definitely, take it in, write a lot of notes, and watch a lot of these videos over and over again, because it's just that repetition. Slowly, these concepts are going to seep into you, and it's going to make sense, especially once you really start to get experience and put some of this into action.
And remember to like and subscribe on the stream.
That's right. Yes, and like and subscribe also. Yeah, quick disclosure here, and so let's get right into these lessons. So the way I look at it, so I've been doing this for over 20 years now. I like to say that I've survived the markets for over 20 years. So I mentioned 2000, where I rode the markets down. So I made the money and I lost all that money in 2000. And so that's what inspired me to really start understanding or trying to get a plan into place. And I discovered Bill O'Neill at that point and been following him ever since and following his lessons ever since. And so the big one, obviously, is just cutting your losses, managing your risk. I had never heard anyone talk about that before. And so that's why it resonated with me. And so in 2008, I just followed the rules, avoided that. All of the other bear markets, avoided those. You get hit a little bit, but avoided the worst part. I know, of course, last year too, anyone who's following IBD or having a set of rules in place, chances are you avoided most of the damage in March of 2020. And in many ways, that makes all the difference. If you can avoid and survive those really bad periods, now you're hanging around long enough to put this together and to get that experience. So now you learn how to protect yourself, and then now you retain that money, and now you can slowly grow it over time. So really the first lesson that I wanted to share is just really keep things simple. Remove that noise. I remember when I started out, there were so many moving parts. I didn't even know what a stock was, really. I never really invested until after college. And so everything, fundamentals, technicals, oscillators, everything, it was just so many moving parts. And eventually I decided that I had to concentrate on one thing. I am a CMT also, and there's so many cool things there to study, and there's so many cool things in fundamental analysis to study too. But eventually, I had to just decide on one strategy and learn that and become an expert at that. And so the reason I loved the IBD strategy, CANSLIM, was it kept things really simple. You focus on great growth stocks. You look for stocks that are changing the world. They have great fundamentals, and then you're letting the chart tell you when to get in and when to get out of these stocks. And I mainly just focus on just price and volume. So, gosh, last year, if you want noise, last year was that unbelievable once in a lifetime type of event. Where anything, it reminds you that anything is possible. So obviously there was so much noise there, in March, or when we had the market signal in April, April 2nd and April 6th, that the market could be beginning a new uptrend. We call that a follow through day. Yeah, there was so much noise that most people were worried about getting toilet paper at that time to pay attention to the market. But the market doesn't care. The market is going to do what it wants, and it's up to you to kind of remove all this noise and pay attention to what the market is saying. Now, obviously on Twitter, I'm sure most of you have discovered TraderLine and a number of these great influencers out there who are sharing their knowledge every day, through Twitter. But there's a lot of noise out there on Twitter too. And if you're looking for a reason to buy or sell, you're going to find plenty of reasons on Twitter to buy and sell any stock. So there's a lot of noise there. And then, of course, just everyday noise in just your life, or any bad news about the economy or interest rates or anything. You're going to find reasons not to be in the market or to get out, or to get into the market. So you want to try to simplify this as much as possible. The markets are complicated enough. So I try to keep things as simple as possible. So as I mentioned before, I focus on just price and volume. I focus on relative strength, and we'll go over these concepts. I don't really use any oscillators. I don't use a lot of other kind of indicators there. And I've tried a number of them, and I'm not saying that they don't work. They just didn't work for me. And a lot of kind of the lessons that I've learned over the years, all that matters is if all these indicators or just the analysis works for you. If they don't, feel free to push it to the side and concentrate on something that works for you and makes sense to you. Because in the end, you have to adapt these strategies, these lessons, these rules to your own personality. And so there are so many great strategies out there. Ours, the CANSLIM strategy, what Investors Business Daily talks about, what Bill O'Neill has taught millions of people about. It's not the only strategy out there, right? I mean, there's value investing, there's GARP, there's everything. But the big thing is, figure out something, try a few, figure out something that makes sense to you, and then really focus on that, because now you can truly become an expert at that strategy. And so by really keeping things simple, it's enabled me to adapt to these crazy markets, because anything can happen in the markets. And so here's a snapshot of last year. And I've highlighted when Investors Business Daily put it into a correction, when we went back into a confirmed uptrend. And if, like I mentioned before, if you're not paying attention, if you're letting the noise get to you, you're going to miss these things because they change really fast. I remember these markets were working really well in January and February, and it almost was working too well because it refused to go down. A lot of these markets, a lot of these stocks were refusing to go down. So I remember it was just kind of ringing in my head, like, things are working a little too well there. So I was just slowly lightening up at that point. And then, of course, then the market really got hit. And so when you see all of your stocks breaking through support areas, giving you major sell signals, you don't question it. You follow the rules. You remove that noise. You don't hope at that point that the market's going to bounce back. You start selling which ones are giving those sell signals to you to protect yourself at that point. So when it went in a correction, started moving to cash pretty quickly at that point, because all my stocks are blowing up. And and then you stay on until you get a signal telling you, okay, maybe try a few stocks. So right here in the market correction, when we started coming back here, we nearly got a market signal right there. And to be honest, I actually tried. I thought we were going to get a market signal that day. So on that day, I tried just one stock. Let me try one stock, very small amounts, just to put a little probe out there and see what happens. And then the next day it started selling off, and I was quick to get out again. And the one of the key lessons I've always learned, the hard way in many ways, is these markets can trend a lot longer than you can imagine. This market, it's funny on this chart right here because this is a pretty big sell-off, but it doesn't. It just kind of looks like a pullback because of the ridiculous rally we had afterwards. But this was brutal, and no one could have imagined it was going to get that bad. All right, but these markets, they're going to go a lot further in either direction, much further than you can imagine. And so that's why we have rules, we have a plan to really help us manage through all this noise, because your emotions are going to get involved. You're going to let the noise get to you. You're going to let losing money get to you if you're not thinking clearly at that point. So once the market's really sold off, once you start seeing all your stocks blow up left and right, and you don't want to buy stock again. I even though I missed out on this part and I avoided this and I survived this brutal sell-off, the last thing I wanted to do was ever buy a stock again, because I was traumatized watching all these stocks just blow up. It's like, oh my God, this is a really dangerous business, and it is if you don't have rules. But once we got a signal to go back in the market and confirmed uptrend, I was like, okay, let me put a little bit of money to work here. I didn't want to buy anything, but I had the rules. I had to battle my emotions of never want to buy another stock again, because all I've been seeing for the last few weeks are stocks are just blowing up. They're going down. I can't even imagine a stock ever going up again. But I bought a little bit here, just a little bit, because I was terrified at that point, and I avoided most of it. But I was terrified by it. I was like, okay, we have the rules. We might have to buy a little bit. And then over the next month, I was slowly buying a little bit more, as I started seeing some of the stocks that I bought were starting to slowly work. So that's the most important thing right there when you're dealing with these markets, because anything can happen. You're letting the market tell you what to do. And that's why I love price and volume. Stocks, markets, they all behave a certain way when they're acting healthy. They all behave another way when they are starting to get in trouble and they're unhealthy. And so the more you learn to focus on that price and volume action and keep it really simple, or at least I keep it simple because it gets complicated very, very quickly, you're going to find yourself more in with the trend of the market than not. Now, I could have never imagined in a million years that the market was going to go do this. Okay, this was just ludicrous. I was like, there's no way a market could do that. But the market, says, hold my beer. I'm going to do what I want. It's up to you to listen to it. And so when I was looking at the markets, when you got this confirmed uptrend, once you went back into this, we had the fall through day at that point. This was on the NASDAQ. I thought that, yeah, we'll probably rally into the 50-day and the 200 and then come back in, maybe build like a choppy range. And then after like 4 or 5 months, start an uptrend, a choppy uptrend. And once again, the market doesn't care what I think. It's up to me to listen to the market, because the market is going to do what it wants to do. And so we had this unbelievable V-shaped rally that didn't really even stop once it got up to all-time highs. It just kept going, right? So you have to keep it simple, because this way you're going to be nimble enough to adapt to what the market wants to do. Now, we kept going a little bit further, and this is back out to March of 2021. And once again, we went in a correction. We chopped around a little here. And ever since, on the NASDAQ at least, we've been chopping around, going sideways this whole time, right? So once again, it is up to us to listen to the market and to really follow that price and volume action, because in the end, that's what's going to lead us in the right direction and stay with the trend. I mean, that is without doubt the biggest thing. So one of the things that I've learned over the years, because charts are, learning how to read charts it's a blessing and a curse, right? It helps you avoid really big sell-offs like we had last year. But once you start reading charts, it's very easy to read them maybe a little bit too closely, right? You're going to find, just like with the noise, when you're looking at charts, once you really dig into this a little too closely, you're going to find a reason to buy or sell any stock at any time just by looking at chart, because they're always coming down to some kind of support area. They're always going to be breaking through some kind of resistance area. And especially if you start using tons of different time frames, you're going to find a reason to get into a stock or get out of a stock. One of our perspective at using the CANSLIM strategy is because our goal at Investor Business Daily at William O'Neill is to catch a lot of times the intermediate part of the trend. We're not long-term investors. We want to catch great stocks when they are trending up and they're consistently trending up. So I describe that more as kind of the intermediate part. It could be 3 to 6 months type of trend. Sometimes they go for a year, like last year when they're really, really strong. The only way you're going to catch an intermediate or even a little bit longer than that is by doing nothing a lot of the times, because even the great stocks, and last year was a very unusual year, and it was almost the perfect type of environment for our strategy. There were plenty of times for all these great stocks, like a Tesla or a Zoom, to sell out of them. And really, and I'll show you some examples, really a lot of times the best thing to do is nothing if you want to try to stick with the primary trend. So our goal is to catch the next game-changing stocks that are truly changing the world. They are services that most of us are probably using right now. And so the best thing to do once you get into them at a proper buy point is to try to give them some room to work. So you want to do that, and also realize that it takes time for some of these stocks to move. Now, some of these lessons that I'm talking about, really, I'm really trying to tell myself that, because even though I've learned a lot of these lessons, I have to relearn them over and over again, because you let your emotions get the best of you sometimes, and you have to, it's always tweaking. So once you get past those really big lessons, like protect yourself, cut your losses, don't lose your principal, uh, then it's a lot of tweaking over the years. And so a lot of these things that I'm saying to you are really, I'm also saying to myself, to remind myself to go back to the basics. So using weekly charts, I prefer starting off with weeklies and then moving to dailies. The reason why I do that is because when I learned from all those seminars listening to Bill O'Neill, his main time frame was weekly charts. And the reason he did that, and it took me years to realize that, is because it removes a lot of the noise. Daily charts are going to give a lot more signals than weekly charts. So it removes a lot of the noise. It lets you look at a longer time frame, and it forces you not to buy or sell that much, right? Because there aren't that many buy or sell signals for great stocks in great markets. So you want to try to do your best to not do a lot when you're in a great stock, when you finally have a great position, when you're up on it a good amount. That's the ideal thing. Those are kind of the game-changing events in your life if you allow some of these stocks to really work. I was listening to Jim Ropel's presentation before. I caught a bunch of that, and I always like listening to Jim because he reminds me of that a lot of time. You have to give some of these game-changing stocks a lot of time, and now he really gives some of these stocks a good amount of time. So it's a good reminder of someone who's been doing this for 30 plus years or so successfully, right? And he's gone through all the same kind of pitfalls that we all go through, but he's kind of adapted it to his system and to his personality. And he has learned over the years to try to give some of these great stocks, these game-changing stocks, a lot of time to actually work and have that patience. So let's go over a question here. How many times are there clear buy or sell signals on a weekly chart? So I'm pulling up Zoom. Obviously, Zoom was one of the great stocks of 2020. And so this is a weekly chart right here. And so how many times on this weekly chart is Zoom giving a buy or sell signal? Well, MarketSmith is drawing a pattern recognition right here. So it's picking up a cup on the weekly. And so really over here, this is kind of the buy point based on this pattern recognition. So you get really one clear time to buy the stock. Now this moving average right here, this is your 10-week moving average, is essentially the 50-day moving average on the weekly chart. And so that's the main one we're going to use to really kind of get an idea of the intermediate trend for some of these great stocks. And when did it really close below this? All the way right here. Right, so this was months. During the pandemic sell-off, during all that time, it took, since it was bought in early 2020, January, February 2020, and this is around the fall of that year. I think that was probably when they announced the vaccine at that point. That's where it decisively broke. I think that's a long time right there. Now, I was in it at this point. Did I hold it this whole time? No. You know, you're human. You're going to make mistakes. Now, the pandemic sell-off freaked me out this whole time. And so if you sold during that time, fine. That's you have to do what you have to do to protect yourself too, right? But when you take a step back and do post-analysis and look at this objectively, when you're not in the battlefield, when you're not emotional at that point, it really didn't break, even though this was a 20+% correction. So if you're getting shaken out there, fine. But you have to find a way to get back into it, especially once the markets are giving a signal to buy again. So I actually got back in around here on this final bounce. As I kept seeing this stock, it's like, my God, this stock doesn't want to break the 50-day moving average or the 10-week line on this weekly chart. Yeah, it's showing tremendous relative strength. We'll get to that lesson in a bit here, but this one was just sticking out to me over and over again. It's like, wow, this is like the one stock that's fighting the trend. If this market turns around, you really want to try to find a way to get into this stock, because this could be the big time leader. And of course, huge earnings, huge sales. This had everything. I mean, you want to talk about a company being at the right place at the right time. It was Zoom. Now, they were showing plenty of potential beforehand too, which is why I bought it over here, because of the huge earnings, huge sales. And they had a great service that obviously we all use and so dependent on right now. It wasn't obvious back then. It was just like, okay, it's a cool conference call, screen sharing kind of meeting place, but there are a lot of them out there. Is this really that much better? And it definitely was. I preferred it, but it's like, how far could this go? Well, we found out. You know, it probably did like a 5-year growth spurt within 10 months or so. And once again, you know, the markets are going to adapt, and so it's up to you to listen to these markets. Here's a recent example. Here's Freeport. FCX is the ticker symbol, and they're copper mining. And how many times has this really given a sell signal? Now, the buy signal is a little bit trickier. You could have bought off the 10-week line, maybe a little bit. It really kind of, here's your first pattern right here. But it hasn't, you know, this stock is a choppy stock. If you're using weekly charts, if you're trying to let them work, and you're, you know, maybe buying a pullback or something, it hasn't given a real clear sell signal. Maybe here when it forms the double bottom, but some of these stocks, sometimes it doesn't matter what company, right? And it might not be growth companies at that point. It might be, you might be in a cycle where all of a sudden cyclicals are doing well, commodity stocks are doing well. And so understanding that and removing that noise and knowing how to interpret this, it's going to get you closer to that. You're never going to do this perfectly, but keeping the rules simple, having a basic game plan, it's going to enable you to catch some of these stocks at the right time. And sometimes they go up a lot further than you can imagine. Now, if you get off and you're locking in gains a little bit earlier, that's fine too. But these are in the cards. Sometimes they just go much longer than we can ever imagine. Morgan Stanley, you know, financials, how often have they been doing well in the last 10 years? Well, you know what? They've started to wake up too. They formed, Morgan Stanley broke out of a consolidation right here, jumped up, found support, formed a flat base here, gave another opportunity, formed a cup, gave another opportunity. Hasn't closed below the 10-week line yet, right? Or maybe a little bit right here, but it hasn't been convincing, right? So some of these stocks, when they truly are in favor, they can go much further than we can imagine, because it takes time for a lot of these institutions, these larger players, think of a Fidelity, to slowly build position in these stocks. And then also, not everyone's thinking the same thing at the same time. So it's the money slowly goes in as more evidence comes out, as more data comes out. But a lot of times you can pick up on these trends a lot earlier just by using these charts, keeping it simple, and studying how great stocks act in a great market. So lesson number 2 is you're really understanding the pattern. Now, when I learned this, when I learned about the cup with handle and things like that, I started seeing cup with handles everywhere. I saw them on 5-minute chart, and they are really. I mean, you can find cup with handles everywhere, right? And it doesn't matter what time frame. I was seeing them everywhere, right? But you want to really understand what type of pattern are you really looking at. Now, for us, we're looking for a cup with handle that's 7-8 weeks long at least. Now, the depth is no more than 33%. It should be nice and U-shaped, hopefully symmetrical, hopefully puts in a nice handle that descends no more than 8 to 12%, and then a powerful breakout. That's kind of the ideal thing. Now, they don't always, great stocks don't always form these beautiful cup with handles, but they're close enough. After some practice, you learn, okay, it has most of the stuff. Let me take a shot. So really the first step at learning how patterns look and how they behave is just getting your eyes trained at how they look when they're completed. Then the next step is, how should they act after they break out and give you a chance to work, right? When they're truly in favor, understanding that behavior when they're under accumulation. Uh, then when you want to take it to the next level, you really want to start to anticipate. Now, you might not buy it at that point, but you want to start to anticipate that as it starts to build the right-hand side of a pattern, how should it look? So all of these aspects, it's really just at stages of development in analyzing charts. You got to train your eyes looking at enough examples of that. And so that has taken me years to really do that. Now, the cool thing is that a lot of these videos, a lot of these examples out there, with a MarketSmith, or there's just tons of examples out there that you can train your eyes to really start focusing on this. I remember years ago when I was starting to learn this, I would go and photocopy a couple of the pages in the blue and green books, the chart books back in the day for daily graphs. They always gave 2 examples every week. And so in Boston, when I was there's a Boston business library. I think it was right near State Street. I would go in and grab the 2 books, I'd photocopy, and I'd built my own little library. Now, gosh, TraderLine they have their own model books that they're sharing. There's a lot of great examples out there, and you just want to look at them. The first 100 pages in the How to Make Money in Stocks book by Bill O'Neill, that's your template right there, where you just want to look at these, and eventually your eyes are going to become so accustomed to it. So really that first step, this is Shopify from last year, you want to understand how a pattern looks when it's completed and breaking out, right? So it's U-shaped. Now this is far from a perfect pattern right here, and this is on a daily chart, but it's far from a perfect pattern because we're up here in this black line. This is the S&P 500 line. Here's your pandemic sell-off. So naturally, all the stocks are going to be dramatically affected when you have a big sell-off like that. So they're going to be a lot deeper. But you want to start to understand, okay, how should they look? How should they look when they're breaking out? How should they act after they're breaking out, right? So once they break out, they should work. Or if they don't work, we cut our losses. Something's off. It might be us, it might be the market, it might be our stock picking skills at that point. We just might be in the wrong place at the wrong time at that time. But when they work, they should trend up. And we're looking for that 20, 25% in good markets. In choppy markets, it might be 15% or so, but that's kind of our plan right there. How should they behave after they break out? But really the next step where you start getting ahead of this, where you start to plan, when you start to discover and expand your watch list, is how should stocks look when they're building the right-hand sides of basis. So this is Shopify before it broke out, and it started, and pattern recognition is not even picking it up here, but it's like, okay, this is still an ugly base, but at least it's gotten back above, here's your 50-day moving average, gotten back above this, gotten back above a shorter term resistance, volume is increasing. Maybe it has a chance now. Maybe it's starting to put in a bottom. Maybe I should add it to my watch list, right? And so now it gives you some time, especially maybe you already know a Shopify, but if it's a newer stock, it gives you some time to do some research and figure out, okay, what does this stock do? Maybe I should consider it when it breaks out. And so at that point, if you do all that planning ahead of time, when it breaks out, there's no hesitation. You know when to buy it, how many shares to buy, and you're in, and now you want to see what the market tells you if you're right or wrong on it. So you really want to start to train your eyes at those different stages. Now, let's talk about relative strength. So when I started out, I was focusing on price, then price and volume, right? But it took me years to truly understand relative strength. And now when I'm asked, what's your favorite, that if you had to choose one, what's your favorite? I would choose relative strength out of everything, the RS line, because if you're paying attention to the RS line, you're going to be fishing from the pond that's in favor at that point. And so this aspect for my analysis become that much more important. So let's just make sure we're all on the same page for RS line. When we look at a stock, we're comparing that stock versus stocks versus S&P 500. Okay, so when the stock is moving up, it means that the stock is outperforming the S&P 500. When the line is moving down, it means it's underperformed the S&P 500. So we're paying attention to this blue line underneath the price and volume on the MarketSmith charts to just let us know, hey, is this stock becoming a leader or not in the market? And as I mentioned, this is one of the biggest things I learned in-house because I couldn't believe it. You know, we have a list, this list we go through on the weekends called the MarketSmith Growth 250. When we were developing it, you know, we were getting over 300 stocks on this list. And I'd asked because there were some stocks that were coming on that had no earnings and the fundamentals were terrible on it. But I was like, okay, why is this in the list? And they'd point, look at the RS line. It's like, you might not buy, but don't you want to at least be aware of it? Don't you want to just see the name, maybe build some familiarity with the name? Again, you might have some time to do some research on it. So this is where I really started learning in-house, like how important this line was. And once again, it gets back to the removing the noise, keeping things simple. A simple indicator like that can help you be focused in the right place. Now, we introduced also the blue dot a number of years ago in MarketSmith, which it combines both the pattern recognition and the RS line going into a 52-week high. Those, when you kind of combine both of those, especially when you're in a correction, you could be looking at one of the next great leaders in the market. So that's why we developed that indicator. Really, the reason why we developed it is because it was getting too complicated for us to remember all these things. And we saw all these markups from Bill O'Neill saying, oh, look, it's in a correction. Stock hasn't broken out yet, but its RS line's in a new high. This is becoming a big time leader in the market. And so you circle the RS line left and right. So we're like, okay, let's just program it in there because it makes it easier for all of us to find it. So remember, this was the sell-off. Now this puts in much more perspective, right? How devastating the sell-off was last year. And obviously, you don't have to tell anyone. I mean, we all know just by experiencing it last year, but it was just brutal when you look at a chart like this back on March 26th of 2020. But here's Zoom. Well, it's new highs, right? Zoom's like, pandemic sell-off? What pandemic sell-off? It's in a new highs. It's fighting it. And so this is relative strength right here. Look for those stocks that refuse to go down, right? That are fighting tooth and nail to go down. And a lot of times when the market starts to get back into an uptrend, when that environment gets better, those stocks that were fighting it, they can really now accelerate. Now, obviously, you're putting the sales and the fundamentals and story together too. But a lot of times you're going to discover these ideas technically, both on the price and volume action and also the relative strength action. Here's Zoom on a weekly chart, and here's your RS line. When it's going like straight up like that, it's dramatically outperforming the market. Here's the market going down. Most stocks are going down. RS line's straight up through the roof, right? So way back then, it was telling you that this stock had tremendous potential. Even if you didn't know what Zoom did at that point, you saw the huge earnings, huge sales, and something's going on here. For some reason, institutions are selling every other stock, but they want to buy more Zoom. And so that's what this RS line is telling us here. Now the blue dot here is Shopify, as it was built on the right-hand side of the base. We have a little blue dot that lights up as the relative strength line is hitting a 52-week high, and it's forming a base. So right now, the market's with pattern recognition is building a base here. It's trying to figure out, okay, is this a consolidation? Is it a cup? It eventually becomes a cup. It's trying to figure it out, but it recognizes, hey, it's hitting a 52-week high. So the relative strength line is in new highs. Price is not in new highs just yet. So this is the concept that Bill O'Neill was talking about, and we saw those markups of old charts where he was just marking those up consistently during a correction. So what did the RS line tell us for the first half of the year? If you're paying attention to that, don't buy new tech stocks at this time, right? If you have old ones at low cost basis, fine, you can hold on to them, but don't buy more because they're not in favor at this point. The oil and gas stocks were in favor. The financial stocks, commodity stocks, they're all in favor. Their RS lines were going through the roof, right? Focus on this. And so a lot of times that's going to lead you in the right direction. So the market was screaming, hey, the tech stocks need to rest. So that doesn't necessarily mean that they're done. They just need to rest, focus on the RS line. Here's XEC, Cimarex Energy, RS line, doing really well. Morgan Stanley again, RS line, going in a nice uptrend right here. Dick's Sporting Goods, uptrend, right? All of a sudden retail starts to look more appealing to the institutions. And then here's Tesla, right? And, I mean, Tesla still is a monster company, but even the greatest companies, or the companies that have the greatest chance to change the world, and I mean, really, is there any other company like a Tesla that has the potential to change the world? It already has it dramatically in so many ways. Even those great companies, they need a break. So it doesn't necessarily mean that the stock is done, it just needs a break. And for the last 6 months, and the market was saying, okay, maybe if you bought your shares, down here, you have a good cost basis and you want to hold longer, that's fine. But you don't necessarily want to be initiating new positions on it, because right now tech stocks are out of favor. Here's Zoom. Tech stocks are out of favor right now. Now maybe the relative strength lines start to come back again, start to outperform. Tech stocks are starting to act a little bit better. Zoom still has a lot of work to do, and same with Tesla. But the RS line right now still isn't saying that these are going to be the leading stocks at that point. So things like this simple can keep you in the right direction, keep you fishing from the right pond. Now, lesson number 4, and it's really simple. When you trade, especially the trade the way we trade, you just are. It's a very human part of the game right here. You are going to be making mistakes. You're going to be emotional, so you have to get used to it. So I mentioned mistakes. You're going to make a ton of mistakes. Okay, just get used to it. You're going to be wrong more than you are right in the markets. The markets are insane. They're absolutely insane. Anything can happen in the markets. And so the more comfortable you get with making mistakes, and the more comfortable you get with being wrong, and just having rules to protect yourself when you're wrong, the better off you're going to be. The chances are you're going to survive the markets when they just go insane. So learn to love those mistakes. Okay, embrace them, because those mistakes are going to be your opportunities to learn in the future. Okay, so when I started out, I learned about Bill O'Neill's 8% rule, and it's okay, that makes sense, but I didn't follow it. And I rode some stocks, and this was 2000. I didn't know we were in a bear market. I wasn't following the larger market part. I didn't get the M in CANSLIM just yet. And I rode a number of these stocks down like 80%, and then I was finally like, oh, that's why they have that 8% rule. It's going to be really hard to make that money back. So once I learned that, wow, I'm going to be wrong a lot. Get rid of your ego. You're going to be wrong a lot, and that I think is the biggest shock for everyone. And this is the reason why a lot of times you hear that really smart people have a really hard time studying trading the markets the way we trade them, right? Because they're so used to being right and not making a lot of mistakes. It's a big shock that they're wrong, but they did all their analysis. This is why the stock should go up, all this stuff. And the market says, I don't care. We're going through a bear market now. Everything goes down. And so it's very hard for people who are used to being right for a long time to all of a sudden understand that, hey, in the markets, anything can happen. You can put somewhat of a structure in place, and Bill O'Neill's done an incredible job writing so many rules down to put a structure in place. And in the beginning, it seems very black and white, learning these rules, like, okay, sell cut your loss to 8%, buy out of bases, all this kind of stuff. But once you learn this, once you really get into it, you learn that instead of the black and white, there's a lot of gray there. And so you have to learn to be human and understand you're going to be making mistakes. You're going to be emotional. You just got to be aware of it to manage it. I've been doing this for over 20 years. Those emotions haven't gone away. I've just become much more aware of them, and I can manage them better, right? As opposed to when I would cut my losses and I would be wrong on a stock in the beginning, I would dwell on it for days, for weeks. Yeah, and and it was hard to recover from things like that. But now it's like, I'm wrong. Oh, next. I don't even remember the last few stocks that I've taken losses. I've just moved on. It's like anything else. You get better at it, but you survive these markets where things just go crazy. And so emotions, look, emotions they're part of life. They're going to be, you're going to feel them in intense ways in the market, especially once you put your hard-earned money on the line. Now, powerful breakouts are scary, earnings gaps are scary, and pullbacks. I find all of these scary, but you have to learn to realize your emotions and then use these kind of signals to get into some of these stocks that are doing something so unusual that they could be some of the next great leaders. So let me just quickly move along here. But even though all these are scary, this is what I remind myself. It's much scarier to miss out on a great stock that you've been watching, that came up on your radar. I was in Apple in 2004 with that perfect cup with the handle, and I sold it a few weeks later. That's a lot more painful and a lot scarier. Okay. Now I participate in Apple plenty of times, but it just sickens me that I got out of that stock way too early and really started seeing all the stuff coming together too. So you're going to be scared, you're going to be emotional in the markets, but missing out on great stocks is much scarier in my opinion. So let's go over some of the powerful breakouts and earnings gaps, because this is when the markets are screaming at me saying, pay attention to these stocks. Pay attention, do some research. Some of these are going to become the next big winners. Now, when you're in a great market, leading stocks are going to give you one chance to get into them, and then they're gone. Okay, and they're gone for a couple of months. They're so hard to get into them. Think about Zoom last year. Once it got going, it was gone. It made it very hard. Now, leading stocks are going to break out powerfully, usually on big volume too, okay? So a lot of times they break out, they're so high, they're at new highs, huge volume. No one wants to try them. No one wants to be an idiot at buying at the highs of a stock, right? But the reality is the best stocks are going to do that. And the other crazy thing is they'll punch these great stocks. They are going to gap up on earnings because some new game-changing event has come into play that has shocked Wall Street. And they've blown out the numbers. Wall Street realizes they don't have enough of this stock, and they don't care about the price at that point. They need to get their position in, and that takes them. They need to get their 2% position, and that's like a million shares that they have to get, and it's not just one fund. So learn to recognize some of these insane, scary action that you never want to buy, and at least get on your radar, because you could be looking at some of the next great stocks in the market. So with the powerful breakouts, here's Shopify coming out of that cup, which actually looks a lot better once you go out a few months. On that day, it's all-time highs. Who wants to buy the market at that point after that brutal sell-off? Well, when it broke out of this cup, it was up 6.7%, and the volume was 105% above average volume. So there were institutions falling over themselves to buy it. Why? Now it's easy to understand why. Going back, it's like, well, no one could go in the regular stores. The retailers couldn't, be at their stores, so they had to figure out another way to reach the customers. And so everyone was getting on to Shopify and buying their services, so they could contact and develop a relationship with their customers and sending their products that way. Uh, so the market, the price and volume action was telling us this at this point. Something's going on here. It might not work, and that's why we have why we cut our losses. But guess what? When some of those that do work, once they're gone, they're gone. It makes them much harder to get into. So these powerful breakouts they're screaming at you, just pay attention to it. Look at the huge earnings and sales, pay attention to it, do your research. And ideally you want to do your research as it's building the right hand side of the basis, so when it does break out powerfully, you're in, right? Because if you wait a lot of times, and now you're doing your research, by the time you realize it's a good stock, it might be gone, and it might not give you that great chance to get into it at that point. Let's talk about earnings gaps, because now earnings gaps are more insane, and they're even scarier, and you don't necessarily have to buy them, but and sometimes I'll buy for the great stocks that I really have a lot of conviction. I will start buying a little bit on the earnings gaps to try to build a position. Most of the times I'm adding to watches and go, there is something going on here. Let me quickly learn what is going on here. Now, the reality is a lot of the leaders that we look for, a lot of these growth leaders, leaders are going to have huge earnings gaps at the beginning of their runs. And that's the realization of Wall Street, realizing they are behind this story. They do not understand the story. This company is growing much faster than they realize, and they don't have enough shares. That is a nightmare that is scary for portfolio managers who are running a growth fund. So these earnings gaps, once you learn to recognize these, they will get them on your radar. And once again, they work because they are scary to buy. Not too many people are going to buy earnings gaps after an earnings report. Now, this is how I learned about earnings gaps. This was Google in 2005. It broke out on this. Here's your breakaway earnings gap, just a really strong gap, right? And I was like, you know what? I'm going to wait. This is way too high. There's no way I'm going to buy it at this point. It's too high, and you know what? Gaps always get filled. So I'll wait for the gap to pull back, settle down, and I'll get into it nice and neat. Well, the gap never filled, and I'm still waiting to buy Google at this price. And waiting. It's now 15 years or so. I'm still waiting to buy Google at that price. Okay, sometimes these companies are changing the world, and they just leave you behind if you don't recognize when there's some game-changing event happening. Nvidia 2016 started out with an earnings gap right here. Got within the base earnings gap right here, gave it the catalyst of build a cup with handle, moved up, reported another earnings, and gapped up again. Okay, institutions don't care at that time. They have to get their shares. Here's our monthly chart. Look how far it's run. Facebook built this huge consolidation, 2013, broke out massively on this earnings gap. I think it was up 20-something percent or 17% on that day. Look at the volume at this point. Something's going on, right? Facebook's finally proven that they can monetize their mobile app. Institutions start falling over themselves to buy it. There it is on the monthly chart. If you're waiting for some of these to come back and fill their gaps, you're going to be waiting for a long time. And Tesla, all right, this is back in 2013 too. They actually gapped up on when they exceeded expectations first on their sales. Then when they reported earnings, they reported some good numbers there, and had another massive gap, and then Tesla was gone. Okay, so you don't necessarily have to buy the earnings gap, but for some of these great stocks, if you want to find some of these great leaders, put them on a watch list at that point. Something's going on. Wall Street's happy to pay insane prices at that point, but they might look insane at that time. But you know what? It looks like a pretty good deal now when you look at a monthly chart for Tesla. So another lesson I wanted to share is just you're always evolving, you're always adapting, you're always learning. Now you still stick with the larger strategy, but you're refining and you're trying to improve little aspects. So a few years ago, and I became very comfortable buying strong breakouts, earnings gaps. I was tasked, and I've been a PM for over 6 years now. I was tasked with, okay, you got those points down well. You got to become better at buying at other points within the base. And I was like, well, I'm comfortable buying this, this gets me in the right stocks this time. And so that was my challenge. So I had to kind of retrain myself to recognize some of those lessons I shared before, buying within the bases or as they're building right hand side of the base. And I also had to get better at managing positions too, right? Slowly scaling in, slowly scaling out. The reality is, years ago when I learned this, it was all or none. I'd buy all my shares at one time, and then when I want to sell it, sold all my shares. That puts a lot of pressure on you being right a lot. I found it much easier to navigate these crazy markets and these insane growth stocks when they start moving by scaling in, scaling out of positions. This way, you don't have to be right. You can lighten up a little bit. You can get out and take a little bit of profit, and then as it pulls back, buy a little bit more. So that enables me to stay with some of these stocks a lot longer. Buying up through the 50-day, that's a new one where I've worked over the last number of years, looking at a lot of examples of that, trying to retrain my eyes to recognize, okay, if this is a great stock coming up through the 50, let me buy a little bit there. And then shakeouts too. Those are the motions, right? Getting scared out of these stocks. I would get shaken out of these great stocks. They reverse, and I would be kind of the deer in the headlights, and they just leave without me. And I was right on the stock, and I didn't have anything to show for it. So those are the things that I was tasked to get better at. And what I learned is it really is hard to change. It took me years to really start putting it into practice, because my brain was so wired at the breakouts, at these powerful breakouts, that it was hard to shift. So I had to look at a lot of examples. I had to break habits, but I had to adapt, because the reality is not every cycle is going to have powerful breakouts. Even last year, they didn't always have powerful breakouts last year, because it was such an unusual V-shaped recovery. But a lot of them all built right-hand side bases coming up through the 50 days. So you had to adapt to get into some of these stocks. That change does take time. So you want to be patient with yourself. Okay. I think it was Tony Robbins that said, people overestimate what they can do in 1 year. They underestimate what they can do in 10 years. This is a long-term strategy. Right? This is not a get rich quick. This is a get rich slowly. You will keep getting better and better at this as you put more experience. And so you want to look at a lot of examples and keep training your mind. In the end, it comes down to mindset. There are plenty of times over the years where I've wanted to quit. I would just, tell them, what am I doing in my life? It's like you go into these ruts where everything you touch just blows up. It goes down. You're snake bitten. And you have to do everything you can with that mindset to kind of look at those, that there are going to be better times where your type of stocks, your environment is going to come around, and you have to survive to profit off of those times. And so it comes down to the mindset, kind of keeping in perspective and realizing, hey, this is a long-term game here. I need to just get through a number of cycles, get that experience, and I'm going to get better at this. But I'm never going to do it perfect, though, too. I'm going to make tons of mistakes. I'm going to be frustrated left and right. But at least I'm going to slowly make money and get better and better at that. So coming up through the 50, I showed this with Shopify, coming up through the 50, recognizing that. Here's Zoom. Zoom was running on this really big run, and I had a position. I was coming in, I was starting to lighten up, and I had a shakeout right here. And I was like, uh-oh, and I lightened up more at that point. I thought that this was okay. Maybe it's going to build a bigger base. Once it reversed and came up through, I had to buy my position back. It's like, even though it's like, you're price anchoring, you're like, oh, but I just sold some at 230. Why would I want to buy it at 250? Because of action. You have to recognize that price does not matter at that point. Something's going on. You could have been caught in a shakeout. And Zoom obviously doubled at that time, or almost doubled at that time from here. It had this monster earnings gap a week later. And, institutions are going to do everything that they can to shake you out of the greatest stocks too. Okay. Some bad news is going to come out. They're going to do everything they can. They're going to hit it and they're going to sell 100,000 shares and then have a big bucket to buy 400,000 shares or whatever, a much larger position as it comes in, because they can't buy at breakouts. They're the ones forming the bases. Here's Cloudflare back in 2020. It had a shakeout, right? Undercutting this 36 level, shakeout, coming back up through the 50, then your breakout, started to work, and then you have an earnings gap, right? So the more tools you add to your toolbox, now you're going to be able to adapt to markets a lot better. So just realize, breakouts aren't always going to work. Pullbacks aren't always going to work. So once again, the more things you have in your toolbox, the better you're going to be able to adapt to the environments, because they're never going to be exactly the same as the previous environment. They're going to be similar, but there's going to be a slight adjustment to really test to see if you really can hang on to some of these growth stocks. Now, finally, the other things, be willing to learn from others. Obviously, you guys know in FinTwit, there's a lot to learn. You can learn from a lot of people who've been doing this for years. So it's an incredible environment. So you want to always keep an open mind and adapt, but you don't have to completely change your strategy. So I'm always listening to what other people do, but I still, 90% of my strategy is my CANSLIM strategy, and I'm picking a few other things and adding it to there to fit to my strategy, and more important, my personality. And then very quickly, routines. Consistency is the most important thing. Okay, I do most of my work on the weekend. I come up with a game plan. During the weekdays are too busy. Come up with a game plan on the weekend where the markets are not working. Where they're not open, you're not emotional. You come up with your game plan, write down your rules. I want to enter here, how many shares, all that stuff. So then during the weekdays, you know exactly what to do when you're more in an emotional state. Now, a lot of people who started off in the beginning, they would always feel like they have to do like 10 hours a day. You don't. You can do 10 hours a day left and right, and during a correction, you're going to really struggle trying to buy stocks. It's consistency. If you do 1 hour on the weekends to develop that game plan, and a little bit during every day, just to keep what stocks, what alerts have been triggered, things like that, you're going to do a lot better. Because the biggest thing is you have to hang around long enough to participate in markets like last year, where it was like the perfect environment for our strategy. Then, of course, post analysis. Okay, I hate doing post analysis. I don't like looking at my mistakes, and it really bruises the ego. But it's a necessity, okay? Because that's how you learn. And if you're brave enough, then you can also talk with someone, show someone else your mistakes, and someone who's experienced, they probably can lead you more in the right direction. And those are I hate those conversations even more. But keep an open mind and realize you don't know everything. But the more you can learn, especially from others who have been doing this for a while, the closer you're going to get to managing that next cycle even better. Every opportunity, every uptrend is another opportunity to really learn and put this into practice. So Richard, that's it. I've taken up like all the time, but if there are any questions, if hopefully anyone's still there, I don't know, but
no, we're all here, and
okay,
you're on a roll. I didn't want to stop you and interrupt
that's
you.
Fine. That's fine.
That was fantastic. So we've got some great questions here. First of all, some people want to know, how do you personally buy earnings gap ups?
That's a good question. So the only the earnings gap ups that I will try are the ones that I already think are game changing. So it's a very, very small amount of the growth stocks even, right? So these are like a Facebook on that example I showed. I bought it there. A lot of times it might be, my goal is to get like a 15-20% position in the stock, it may be 3 to 5% on that day. Now, I'll see it a lot of times. You'll see on the after hours moving, or oh my god. So the next day, I know I might have to be pretty quick. For me personally, and this is something I might have to become more refined at. If it's like a Facebook or something on that day, I'll just buy it right when it opens and just slowly buy throughout the day. I know a number of the guys on IBD, they'll use the 5-minute charts, and they'll wait for the first 5-minute bar to form. Then if it takes out the high of that, then they'll start buying. So that also makes sense. There have been plenty of times where I bought right at the beginning and I've been stopped out like 5-10 minutes later. I'm like, I'm such an idiot. So yeah, you play around with that, but I buy small on that first day. And a lot of times then you want to hopefully it settles down a little bit over a few days, then you can buy a little bit more, but it's that scaling in process.
And is there a kind of minimum percentage gap up that you'll play? And also, do you care where it's gapping up from versus a fully formed base versus it's already kind of extended within its run?
Yeah, so they should be ridiculous. Like a lot of times the most powerful ones they've gapped up 5-10%. It's like they're already extended from a base. my favorite ones are within they're within the base, kind of like that Nvidia example in 2016, because that's nice because they haven't really, it's not extended yet, so you can buy some there and you can slowly scale up and then finish your position as it breaks out of the base. A lot of the times it will be breakaway gaps. So like that Facebook example, a big consolidation, gapped up, it was probably like 5 to 10% higher than the pivot. Those a lot of times are going to be the ones you see. I'll buy it at that time, and I'll ideally, if I can survive that day, I'll use the low a few percent below the low of the day as my exit strategy.
Right.
And then I'll just really try to respect that. It shouldn't, if it starts undercut and get into that gap, I'll start lightening up because it could fill the gap. A lot of times it doesn't, but I'm not going to take a chance. I'll lighten up a bunch, and then now if it gets back above that low of that earnings gap day, then I'll start to enter it again.
Perfect. So that Nvidia chart reminded me a lot of Docusign recently, because it's kind of a gap up through a kind of double bottom type pivot, that type of thing. And Docusign is one with a lot of volume coming in as well. So that's what I've been watching.
That's true. Now the difference though is that there still is a lot of overhead supply with the Docusign. Sure. So in my opinion, I could be wrong on it. It might need more time to kind of go sideways, build another kind of base or another range that you can buy out of. So yeah, it's a little bit different just because it got so choppy. But yes, it's one that's on my radar right now. But for that one, it's not necessarily that clean. So I'm still waiting to watch it a little bit more.
Perfect. And Dennis had a question. Do you have a favorite MarketSmith screen?
I think. Well, in the stock ideas button, probably the favorite right these days is the RS line blue dot,
right?
Because that's combining both the pattern and the relative strength line and taking a new high. Then we have the breakaway gap screen. I'll look at that. Earnings gaps, we have those screens. When you're newer though, just use the near pivot. I think that's the ultimate one because that's using Grow 250 and near pivot list, and then there's the breaking out today. But yeah, RS line blue dot is probably my favorite.
Perfect. And some people are curious about what your routine is for post analysis. Like, do you take your biggest winners and biggest losers and analyze them, or what do you kind of do?
You take your 3 biggest winners and 3 worst trades of the year, and you want to definitely analyze those a lot. Mm-hmm. A lot of the other trades are going to be like quick gains, quick losses. So you really want to analyze those. Now, if you have more, if you have more time and things like that, then you can expand it to best 5 and worst 5. But for me, it's not only that. It's what I'll also look at are what are the ones that I tried and I got shaken out. Yep. Maybe for like a 2% gain, and they went up a huge amount too, right? And what rules I need to write to try to get myself to hold a little bit better on those.
Right. And I think we only have time for just 1 or 2 more maybe, but I thought this is a really interesting one. Somebody's curious about how you kind of quantify and measure the N in CANSLIM, the new factor.
Yeah, that's a great question. It's sometimes hard to quantify. You have to look at the products and stuff like that. So for instance, the way I really kind of stumbled on Tesla in 2013 was when I saw the car in Santa Monica. They had a showroom, and I saw the car, and I couldn't believe it was $90,000, and they sold out. They were selling out of it. And it was the nicest looking car I've ever seen in my life. It's like, oh my God. I was like, they may actually pull this off. And I was telling a friend who was telling about the system there, and I said, I'll give it a couple of years. Give it a couple of years for Tesla. They have that potential to be a game-changing stock. This might be a great stock. I was wrong. It started going in 3 months from when we spoke. So the market once again doesn't care. But a lot of times the best stocks you'll find are the ones you're using. I mean, think about Apple with the iPod or the iPhone or all the other stuff. Priceline, Netflix. Everyone wants to watch movies at home. Deckers with their UGG boots, so a lot of times it's actually seeing the product and trying it, but usually the first time you'll stumble on is through a chart and the incredible relative strength and the fundamentals.
Perfect. And to finish things off, this isn't necessarily the most fun question, but how have you kind of handled this year 2021 where it's been a lot more choppy versus obviously 2020 was exceptional for the CANSLIM style?
I personally haven't handled it very well, I think. And so when I was saying with those lessons, the relative strength line, the market really taught me to like, hey, you better focus on that relative strength line, because I wasn't focusing on it that well in the beginning. I was still going back to my tech stocks, because I love tech stocks. That's what I usually do better at. I was trying to buy up the right-hand side of the basis, and I completely was not paying close enough attention to those relative strength lines were nowhere near new highs. So I learned probably 6-7 weeks in that I was way out of sync. So the one good thing I did was I dramatically reduced my exposure to the market, and I've been playing small, so I haven't really let myself get too far out of control, because it's just not my environment. So I haven't done a great job in the beginning. I've been better in the last couple of months by focusing more on the stocks that have better relative strength.
Right.
And industry group rankings, that was probably the biggest lesson the market's been teaching me this year. Pay more attention. I wasn't paying enough attention to that.
Yeah, computer software is now like in the 160s or whatever.
Exactly.
Yeah, it had been the biggest leader of 2020. So yeah, for sure.
I mean, the good thing though, I know, and this is where experience really helps, is there have been other years where it's been choppy. I've kind of chopped around and struggled. But then when my kind of stocks get back together again, get back into favor again, I can make it up very quickly. And all of a sudden it turns into a pretty good year. So, so the biggest thing is, when you're out of sync, just, don't force it, take a step back, play a lot smaller, and wait to get back into sync again.
Perfect. Well, Irusha, thank you so much for your excellent presentation. We really appreciate you coming on and being a speaker. It's been a lot of fun. And with that, just thank you, Irusha. And next up, we've got Matt Caruso. He'll be coming on shortly, but we're going to take a quick break. But everybody in the chat, make sure you guys thank Irusha for that really excellent presentation. Yep.
All right. See you, Richard.
See ya.